Good day to all of you. On behalf of the organizers, Investment Trust Info and AKW Consultant, I welcome all of you to the webinar series on real-world asset tokenization. This is the first in the series of webinars. Today, we will focus on precious metal tokenization, the future of digitizing precious metals. My name is Srivatsava, or short Vatsa. I am the CEO and Director of Eventel Global Advisory, the company that owns Investment Trust Info. We are indeed very fortunate to have 5 distinguished speakers today. 2 of them tech native, they've taken to gold, and 2 of them are from the gold industry who have taken to tokenization. Plus we have Mr. Micheal Wharton, who has seen and worked with most of them. So this is a very, very rich lineup of speakers with rich experience, relevant experience. They will take us through this fascinating world of tokenization in the context of precious metals. We will go with Mr. Gregor Gergersen, the founder of Silver Bullion and the Reserve, Singapore. We will have this format, a very simple format. We will request each of the speakers to come and share a few of their initial thoughts, a couple of questions. We move on to the next speaker. And then once we finish with all 5 speakers, we will have all of them and have a rich interaction. That's how we plan to do. I'll invite Gregor Gergersen. Before I call him, I just want to give him a brief introduction. As you can see, he is renowned for building one of Asia's most robust private vaulting and precious metals logistic ecosystem. His expertise is custody, allocated gold system, systemic risk mitigation, transparency, and physical digital bridge. He is a strong authority on allocated versus unallocated gold, vaulting standards, and investor behavior. He has, to his credit, also launched gold tokens. More about it, I would let him speak. Gregor, over to you.
Yeah, thank you very much. So the topic of tokenization, I think, is something that there's a lot of misunderstandings in this industry, and it's definitely something interesting to get into. So thank you for the introduction. Just a quick update. We doing about $3 billion for clients now directly, as well as more for indirect clients in a vault which can hold about 500 tons of gold and 10,000 tons of silver. So as another bit of background, we did build a gold token in the past, cash gold token. And we learned a lot about tokenization and the realities of tokenization, the problems of monetization, as well as the jurisdictional and regulatory issues, as well as bank de-risking issues. And these are oftentimes the type of things which people don't realize when it comes to tokenization. But the concept of tokenization is that you take an asset, real world tokenization will be, let's say, a bar of gold, and you subdivide it into fungible units. Let's say a 1 kilo bar could be 1,000 grams of gold. You create some kind of POR system, meaning proof of reserve system, on tracking how this works. You can also do without it, and you just have a vault statement basically. And then you have a tokenization company, which basically says, I now have 1,000 tokens, each one worth 1 gram. And there's going to be some rules on who can access this and what it's going to be backed with. So one very important thing to understand is that the original idea of tokenization is to do it on a public blockchain. And a public blockchain means that you can take these tokens and you can transfer it via your own wallet to other entities. You can trade it on crypto exchanges, and you pretty much can use it the way you use the Tether stable coins or Ethereum or Bitcoin. And this really is the promise of tokenization. In practice, however, and we did build a token like this, but in practice, when you do that, there oftentimes is a travel rule that comes in with regulators requiring this, which basically is saying, no, we want to know which tokens are going from which party to which party, and it needs to be more like a financial system sort of setup. And therefore, oftentimes regulators will say, in your jurisdiction, you're not allowed to do a public token. And instead, you're going to make a token, which essentially is restricted to be held by financial institutions, cannot be freely traded, and might be residing on a non-public blockchain. And if you have a non-public blockchain, it really misses a lot of, say, good things about a blockchain. If it's not public, you have to rely on an entity which runs the different nodes, and it's not much point on having a blockchain once it's like that. So these are more or less the foundational parts when it comes to tokenization. But In theory, once you have such a token, depending whether you can trade it publicly or whether it's going to be a restricted token, you can only have financial institution use it. You have a very different user profile behind it. And when it comes to allocated versus unallocated, I've never really seen an unallocated token because it doesn't really inspire much trust. And one of the main problems of creating a token is building trust in it. So one way or another, there always has to be some kind of gold behind it if you're talking about gold. And of course, that gold has to be allocated. And when it comes to transparency, so essentially from a vaulting perspective, you either go to old school, which is that you provide a vault statement to the tokenization entity. And since the tokenization entity every now and then uses that as proof to say, look, I really have 50 kilos of gold to back my 50 kilos of tokens. Or in some cases, there's a possibility of having the vault itself provide Oracle type of service, meaning that there's an on-chain transparency about how many ounces are being held for a particular party, which crypto community can check directly. So that's a type of service which isn't offered much yet in the industry, but it could be an interesting sort of service because it provides a lot of transparency from the vaulting side. And yes, then of course the other part that people are interested in oftentimes is, can you redeem it? The short answer is it's always nice to say it can be redeemed, but there are practical implications because small Bullion parts, small gold bars are a lot more expensive than big gold bars. So it gets quite complex in terms of how to organize all of this. But in theory, a gold token should be redeemable. So that's pretty much, the introductory part to the tokenization side of things.
Thanks a lot for the introduction, Gregor. That's a good beginning. I have a couple of questions, quick one. If it's okay, I can take it up because it's fresh in the memory. So there's a basic misconception, I would say, among the investors, between tokenized gold and traditional allocated storage. What do you say about this?
Well, I would say that when you have a gold ETF really is digitized gold already. And when you take a gold token, you have to ask yourself, how is it different from, let's say, a ETF? And that's really where the public side of the token, comes into play. And it's not a technical issue on how to make a token because there's been hundreds of gold tokens, literally, which have gone to the graveyard. Building a token is not that hard, but making it work and having regulatory approval and getting all of these things fixed, that's a very complicated thing nowadays. So once that is done, once you get some parts covered, getting the gold stored into a vault and providing transparency for said gold, I think is a relatively straightforward matter. It is not really the main problem in the industry. It is really the regulatory support, which oftentimes is the biggest problem. And having a value of the token and a use case to it.
The use case is restricted if it is not public blockchain. That's what I understand from you.
Yes, if it's a public blockchain, there are a lot of use cases, but there are a lot of AML KYC issues which the regulators are going to bring up, which is why usually it's not allowed to be used. But if it's not a public blockchain token, then the question becomes, then what is it good for if it can only be held by financial institutions? Because how is it different from a gold ETF or other allocated gold holdings that you can buy in a stock market, for example?
Right. I have one more question. Then later on, I will come back during the Q&A. You're a very big vault operator, and you did talk about investors' trust. In a digital token world, what's the role played by the vault operators in building this trust? How does it manifest itself, in terms of, the whole offering?
Well, I think at the end of the day, a vault is not really involved in the token itself, but its role will be to provide transparency and proof of reserve. Because if somebody has a gold token, the user will go back to the issuer and say, well, how can I trust that it's really gold? And one of the traditional ways of doing that is to say, well, look, here's a vault statement, sort of like a bank statement, saying that my company name here has 50 kilos of gold. That's a traditional way of doing it. Now, with the blockchain, there is another potential way of doing it, which is, as I mentioned earlier, to provide an oracle, meaning that the vault itself could provide an API kind of interface, which provides the data to a contract on chain, which makes it easy for other smart contracts and the online community to check it. In other words, you can think of it as well as making a website, so to speak, and showing what balance each one of the accounts which want to be publicly viewable have. And because somebody will be going to the website or to the specific smart contract of the vault, it will provide more credibility compared to just a vault statement. Because a physical vault statement, nowadays it will be much easier to fake and copy and so on. So that's one way for vaults to provide more transparency.
Thank you very much. Thanks for now. I have many more questions on the cost side, and also, you did mention about dealing with small holdings. I will come back to you once we finish up with all the other speakers. Thank you so much. Please stay with us. We now go and understand a little more about technology. For that, I'll invite Mr. Micheal So. He's a CEO of Tokenization. He's a digital asset infrastructure and trading platform. Is focused on exchange integration, liquidity pools, secondary trading, and token market infrastructure. Mr. Micheal specializes in smart contracts, on-chain settlement, and exchange-listed tokenized asset. Over to you, Mr. Micheal So.
Thank you very much. Hi, everyone. My name is Micheal So. I am the CEO of Tokenyze. We are a specialist in tokenizations. We offer something called tokenization as a service. Super excited to be here today. As I said before, we particularly, just like Mr. Gregor earlier, we love the idea that that gold, silver, platinum, palladium can be represented on chain. Mr. Gregor earlier pointed out, there are many flavors of how tokens can represent either, for example, the actual asset or a promise, of the fact that there's some precious metal sitting behind the scene, for example, in a vault. I would love to kind of dive into how, for example, public versus private blockchain, which we both used to operate on, how certain tokens, can be permissions versus non-permission, and at the same time, there is an idea behind what is actually truly owned by the token holder versus, for example, what is otherwise behind the scene, basically either in the front of the promise or at the last of the line. Beginning of the fact that, for example, 3643, one of the standard within Ethereum, ERC 3643, is a standard that can be applied on a public blockchain. The idea is that a blockchain in itself, in essence, is really nothing more than a ledger, meaning it's a location where the, for example, the wallet address that is controlled by a certain first name, last name party can be represented in a quantity on a record. For example, if a certain wallet address, owns 1,000 ounces of gold, they may simply have a quantity of 1,000 on the blockchain. Now, this idea, simply points to the fact that if you were to have different construct behind the scene, for example, if you were to own a 1,000 ounces of vault receipt versus 1,000 quantity of a promise of the fact that another party is holding the underlying metals, and then subsequently deciding when you can or cannot redeem the metals, that kind of decides the flavor of the token itself. In the market today, if you were to look at the leading names such as Tether Gold, such as PaxG, these are the example of, for example, ERC20. They are the example of how these are promises of the fact that there's gold behind the scene, but at the same time it is gated by the fact that they still control whether or not you can redeem or not. And for that reason, even though it is a ERC20, it is a public non-permission token that can be freely transferred between one party to the next party. The actual redemption itself is something that is to be you have to seek permission for.
Thank you. Thank you very much. That was very interesting. You elaborated on many of the points which Gregor started off with. I just have couple of questions. Let me first talk about the interoperability between chains. Is it a reality in the near term, or it's still aspirational?
In my opinion, it is already here. So interoperability, for the wider audience here, oftentimes simply refers to the fact that you may have for example, in terms of the real world asset token, such as gold and silver token, the fact that the token is already issued or already operating, or in my words, already recorded on one particular blockchain, for example, Polygon. And on the other hand, the very same underlying asset being represented on chain may also be represented on another blockchain, such as Avalanche. And oftentimes, one of the more crypto way of allowing for interoperability is to go through what we call bridging. So wormhole, Acela, to some of the example as to how bridging may work. And the crypto bridging, in a way, is actually very different than what we call the traditional route. Crypto bridging oftentimes involve two particular exercises. Effectively, having a particular blockchain to stop recording the very ownership of your metals on a particular blockchain, and then start to represent the very same underlying on another blockchain. Now, if it is in a true Web3 form, it actually requires no permissions in between. And for that reason, oftentimes there may be a party, such as a market maker, that will actually use their own balance sheet to basically buy and burn, a particular asset on a blockchain, and then subsequently mint the representation on the other blockchain. And our firm Tokenyze also actually enables that by effectively using a ERC 3643 standard to, on one hand, force transfer the asset already from a wallet to for example, a holding wallet, or the fact that we allow the users to directly send the token to a burn address on, for example, Polygon, and then allowing that we as a token agent to mint the token on another blockchain, on Avalanche or any other blockchain for that matter. This allows for a very seamless transfer in terms of the quantity representation of the asset, from one blockchain to another blockchain, and allow for the use cases, such as using the token as a collateral towards other activities on the blockchain, for example, financing. So, in my opinion, it's already here. It is not a dream, and it is something that proves the use case of why assets, metals, representing on the blockchain have more use cases than the traditional form.
Right. You did mention about 190 million under asset in gold and silver. What all blockchains currently tokenize support for gold and silver that you own, and for the other companies? Some examples, can you just share?
Absolutely. So we Tokenyze. We are not the issuer, meaning we are not the party that will bear the name of the token. The announcement will come out very soon next year. The token today is representing gold and silver, like I said before, on the blockchain, and in particular Polygon, using the standard 3643. And our approach is the following. We work within the North American space today. We work very closely with basically the entire vertical within North America, from refiner, miner, to dealer, wholesaler, and also other online presence. Our approach is actually a very try and true. We have been in this space for about 8 years already, even before the very first token minted on TetherGo and PaxG. What we do today is that we work directly with the vaulting location. We take what we call inventory management systems and the information from those vaulting locations directly using REST API, and allowing for these vaulting locations to provide instructions to us such that we can perform a very secure M of N, meaning multi-signature transactions on the blockchain, and have those what we call transactions proposed and validated through another extremely safe RPC structure, allowing for the blockchain to regard these proposals to eventually to be validated. But in more layman's terms, what it means is that if there's a party that already is the truthful operator of a vault, we simply directly integrate with the inventory management system at the vault and allow for those inventory levels, so to speak, to be directly represented on the blockchain. And we are one of the first to have utilized, at least within the North American space, especially from a legal perspective, what typically is referred to as a Uniform Commercial Code, Article 7, which spells effectively as warehouse receipt. Our approach allows for the token to have legal basis, which is in essence a UCC's Article 7 warehouse positions, and be able to allow that to basically use as the fundamental representation on chain and also as a backing instrument for any further wrapping in terms of the more typical structure such as ERC20, IOU promise tokens. So happy to dive into the actual exercise. But otherwise, we work with traditional dealers, refiners that allow them to basically represent the asset directly on chain using a very traditional vault receipt structure.
Excellent. It's very nice to know that you offer your services to people across the gold or precious metal value chain. You are the best person, in my opinion, to make us all understand a little more about smart contract standards and which, in your opinion, is best suited for institutional grade gold tokens, and why do you think so?
Absolutely. I just to speak towards our background a little bit, without naming names, we worked with sovereign mints. We worked with some of the biggest refiner in the world, public companies, and also obviously a lot of the wholesalers and the retailer dealers in the space. We have used and was actually in my professional experience, I was the head of tokenization for a service provider that actually became one of the largest user of the entire R3 quarter as a permission blockchain. I also used to tokenize base metals, nickel, copper, and cobalt in another permission blockchain called Hyperledger. And today, our firm, offers services in addition to private permission blockchain to use public blockchains such as Polygon, Avalanche, Ethereum, to represent those assets. And also, diving into the question over here, using particular standards, that can allow for different flavors and basically rules of engagement to be apply towards exercises that the issuer or the community requires. So the standard that everyone has heard of is something called ERC20. ERC20 is the base level token. What makes ERC20 very interesting is the fact that it is a bearer standard, meaning whoever holds the token actually has the right and is the only authority to move the token around. So if you were to hold a ERC20 today, you can send to anyone first name, last name, or any wallet address as you wish. The major difference between ERC20 versus another standard pioneered by Tokenyze on a standard called ERC3643 is the fact that ERC3643 actually requires a third-party agent to be one of the only authority on this particular standard to move the token quantity around. So what it means is that even though it still lives on the public blockchain, enjoys all the validation and the trust nature of how a blockchain transaction can be validated and regarded as final, it still allows for the more traditional approach of seek for permission before you can move something on the public blockchain using the standard 3643. And that how that works is that there is a particular function of the blockchain called force transfer that basically flip the equation around. Meaning, if you were to hold a token, sure enough, you are still checking the box, the truthful title owner of the token. But however, the operation the control aspect of the equation for the time being has been effectively assigned to an agent such as ourselves to basically allow for any checks or compliant rules to be applied before further transfers can occur. So that's one of the I guess prime example as to how still on the public blockchain, rather than being a permission private blockchain, we can still represent the asset, but however preserving the very important nature of the fact that this is still at the end of the day a traditional setup. Still has a vault in place, and the vault still has to regards the rules such as the sanction rules, the transfer rules, without losing the integrity of both the asset and the transfer nature of the business.
Thank you. I have one last question. You have covered in detail ERC 20, ERC 3643, and so on. As a technology person, in your opinion, what technology risk keeps you awake at night when it comes to tokenizing gold or any other real world assets?
Absolutely. Blockchain by nature is a fascinating technology, right? I mean, the idea is what? The idea is the fact that no one single party can unilaterally change the records on the blockchain, and for that reason, makes it both exciting in terms of having a comfort of the fact that this is not something that any party can just flip and change the ledger. But on the other hand, means that you are not the only party that can change the numbers on the blockchain. In my opinion, one of the things that people have talked about in the past, includes forking risk, meaning like if the blockchain, for example, had, the rules of engagement for oftentimes 51% consensus, so-called compromise, then in that case, the chain in itself, from time to time, can have records that can be written to the form where you do not regard them as truthful information. That's one risk. Larger blockchains such as Ethereum, Polygon, Avalanche, having enough validators resolve their problems. At the same time, within a record, which is really nothing more than a proposal and eventual validation of the blockchain, can still be compromised, if your internal organization has been compromised. And what we have done, is in fact, the fact that, the standard 3643 allows for the nature of forced transfer to happen. So even though, if a record, for any reasons, erroneously may have appeared, from a wallet to another wallet, there is still a mitigation allowing for the numbers to be transferred back to the rightful and truthful owner. So that's one example, as to how, number one, we have identified the risks, of using the blockchain, but at the same time, the mitigation towards, how a numbers can be correctly represented regardless of, how it has been initiated, right or wrong in this case.
That's a very valid point. Technology is there, but then even if within all safeguards, if there's something which goes wrong, there is a recourse. Thank you so much, Mr. Micheal. So we'll get back to you once all our speakers finish their initial comments. Thank you very much. We have seen so far introduction to gold tokens, and then we visited a little bit of technology aspects. Now let's look at tokenization infrastructure to provide clarity on that. I now invite Robert Farquhar, who is the Chief Commercial Manager of Ctrl Alt. He has got wealth of experience in building tokenization infrastructure in UK and GCC countries. He focuses on large-scale tokenization infrastructure for institutional clients. He has in-depth involvement in regulatory classification, real-world asset structuring, and institutional adoption. Links Web3 infrastructure with legal audit and financial structuring. Over to you, Robert.
Thank you very much. I just want to close in on that last point very quickly. Now, we all talk, and you sort we're very blessed to have some of the other speakers on the call here today. And I've not disagreed with anything that has been said so far. I think we all know how to make this work in the real world. And I think we understand the differences between what is a gold-backed token versus what is a token which owns gold versus what is an option, all the way down to owning physical gold. I think there's a space in this world for all of those scenarios. But I think where we all get very, very excited, and I think where the market gets very excited at the moment, is how can we blur the lines between some of those? How can we say, okay, you've got a physical piece of gold, and how can you mix that with an option? Now, that's when a token comes into it, and that's when a token that actually owns that gold comes into it. That's when we start having an ownership of a piece of gold on like a one-to-one basis, that you can now say, this is redeemable, this is tradable. You're not trading an option in gold, you're trading ownership of gold that if you want, you can build up a stockpile of and then start redeeming. Now, as Gregor said, there's obviously problems with the redeemability side of it. And I think you won't hear any of us here on this call say that redeemability is the easy part. We all know that is the more difficult part of this, because let's be frank, before you get the redeemability, what you have is an option trade, but with more security. And we in the market know how to trade those. So it's that financial structuring point, which for us as a company has always been the most important part of this market. Now, can someone create a token and say it's backed by gold? Yes, it's easy. Can they create a token and say it's backed by gold and then actually have the physical gold? Yeah, that requires some capital. But we are a tokenization company. So I mean no disrespect to anyone when I say this, but the tech is the easy part of this. The more difficult part, as I'm sure everyone will agree, is what does that token mean at the end of the day? When you're buying that token, what are you buying? Are you buying a token that, like was mentioned, if you want to sell, you need approval for? Or are you buying a token that is your ownership of gold or any asset? And when you want to sell it, it's entirely your right because you own that piece of gold. So you can just sell it. Now, that is without a doubt the hardest part of solving this problem for scalability. It also becomes the most interesting part for getting the traditional bullion players on board. Fintechs have been on board for a long time. We know that trading commodities on chain just makes sense. We know that this is the future. We as a company did this with real estate with the government of Dubai earlier this year. And we showed that you can get direct legal ownership of an asset on chain and then see tradability of that while still maintaining that ownership change as it occurs. And you can do that with gold. You can tokenize, like was mentioned, you can tokenize the warrant in allocated gold. Allocated, without a doubt, is the easier of these solutions. You can do unallocated. You would never do it on a retail basis. You would only do it on an institutional basis, and that unallocated gold will be covered with an awful amount of guarantees from other entities. And then you're just looking at a traditional financial instrument. So people say, what's the point? So allocated gold becomes simpler because you have a very secure, trusted entity, independent of that tradability, sitting there saying, I have this gold and I'm holding it for you. So if you want a token against this gold, you can trade it. And then as that token moves around, I sell it to Micheal. Micheal now has access to that gold because there's an update into that entity to say that the gold has been transferred. And I think that's where companies like Vaults, like Brinks, become so important into this entire scenario, because you can take the gold, you can place it into an established, trusted vault. You can issue a token against that, against the warrant. which means that's the effectively the redeemability right of that gold. And then you can then trade that warrant around in token format. And I think what's super interesting about gold commodities, especially, is this is something we used to do hundreds of years ago. When fiat money was first created, it was when people were taking gold, taking silver, taking diamonds, etc., and they were placing it with a goldsmith, and they were getting a receipt for that goldsmith for their assets. And then after a while, they stopped going back to get their gold and then trading the gold. Then the person would put that gold back in that same goldsmith, and they started just trading their receipts. So that's where that is effectively the birth of a fiat currency. And we are now back there again, but we are in a more transparent, accurate place. So this is something that our ancestors did hundreds of years ago, and they got comfortable with, and they saw this as the way that that trade should be done. And we're now back there again, saying, okay, this is now immutable, fully transparent. Everything is shown on chain. You see that movement going through. And I still get, and I'm sure everyone here still gets questions on this, and you say, how safe is this? And you go, it's perfectly safe. And I would argue it's actually probably safer than trading gold, physical gold, because the gold that you're trading here has already been tested. It has already been vaulted. You know exactly what you're buying. It's not a case of, oh, you think you're buying 22 carat and it's 18 carat. Like, it's very clear what you are purchasing, and you're purchasing that ownership side of it. So it becomes far, far more secure. Now, listen, I appreciate I monologue a lot. I get very passionate about this sort of stuff. And I sort of want to open it up for you, Basta, to see what sort of questions you've got and what you're interested in.
Right, that's excellent. You spoke so well. I think most of the people in this audience would have understood it in terms of where to place this. A couple of quick questions. You said you are already seeing fintech, seeing exchanges, and also Bullion institutions. Are the real users of Bullion, have they taken on to tokenized gold or tokenized precious metals, or still they are not yet there?
I would say yes. We spoke at the Dubai Precious Metals Conference last year, and we spoke about tokenization. And it was almost like we were talking to a room that didn't want to listen. It was the future. It was gobbledygook. They were not interested. This year at that same conference, everyone is approaching me talking about tokenization. And these are the serious players. These are the vaults. These are the refineries. These are the people that are actually the large players and the brokers of this space. And not just in Dubai, further afield. So I would say they are moving. And I think the fact that they're moving is very positive, because let me say this way. If we say fintechs are sprinting, because they always do, I mentioned it earlier, fintechs move fast. They don't have the existing infrastructure. They don't have the problems. They're the speedboat in the analogy. The big bullion providers, the big players, the existing institutions, they're the cruise liners. They don't move quickly in any direction. They move slowly, but when they move with purpose. So those bullion providers are definitely moving towards tokenization, but they're taking their time about it. They're making sure that it's the right decision and the right direction for them as a company. They're making sure that their investors are secured, their buyers are secured, and that approach is the correct approach. So moving, but slower. But once they land, they just bring the scale that fintechs can't match. They bring that institutional play, that institutional stability and structure that we would all benefit from. But I think we're all sort of like guiding them on that path, advising them, ensuring that they make it there. But yeah, definitely on the way. And I think that's why partnerships matter so much in this space. Like no one here is looking at doing everything on their own. It's always about who can you work with to try and move this in the right direction.
Thank you. That's loud and clear. We have moved from early adoption to institutional level acceptance, and you have seen and you have shown us sufficient example of what's happening on the ground. There are clear indications that large scale acceptance is on the way. Thank you very much. Of course, fintech will be always faster, that's fine, but real users, once they get in, they give a completely different color to the whole game. I want to pick your thoughts on another very important aspect, which is counterparty risk. Tokenization, has it reduced counterparty risk or just redistributed risk amongst millions of people? What's your take on that?
It's both. It's both, frankly. Tokenization doesn't eliminate counterparty risk. What it does is it makes it explicit, measurable, and programmable. So when you put something on chain, you can now have very clear rules around how that is operated. It then says, okay, so we've mentioned it already. Michael did a very good point on this. We've talked about smart contracts. We've talked about oracles. You then have custody risks from an on-chain perspective. And let's be clear, like one of the main ones is regulatory uncertainty. We've got like VARA framework has been very clear in UAE on allowing tokenized commodities. MICA has made some changes in how they operate. We've got some great stuff coming out of Singapore. Everyone's looking at saying this can work. But then we say, okay, where were we a year ago? A completely different landscape. Where are we going to be in a year's time? Who knows? So the regulatory uncertainty is definitely there. So they're known risks that you can, I won't say mitigate completely, but you definitely can do things to mitigate. So smart contracts, your smart contracts will be audited and they'll be confirmed. So whenever you're writing a smart contract, there is some work going into making sure that is appropriate. Oracles, it's price feed. Now, there's a lot of education which goes into ensuring those oracles are accurate and the investors that are working with that price feed get a good view of it. If we look at some of the traditional risks, we've got the custodian insolvency. So I talk about the custody management risks from a Web3 perspective. That's just the token risk. Now, if you structure that token in the right manner, you then have a point, like Michael said, of forced transfer. So if you have, as an operator, and we always have these controls, forced transfer, burning, minting, freezing rights, it means you can ensure that the market is kept appropriately. So you massively limit the risk of any custodian wrongdoing for your tokens, because you ultimately have a golden source of ownership, which you can then revert back to. But there is the gold, physical gold. That is probably the thing that most people are concerned with. They're like, I bought a token, but someone else has my physical gold. That's exactly the same risk as if you vaulted it yourself. I, like many people here, invest in gold. Some of it's physical, some of it's virtual. The physical gold I have, most of it is not stored in my house. It's stored at a vault, because why would I keep it in my house? I trust that vault. Benefit of something that becomes scalable is those vaults are not small vaults. They're very serious players. So incredibly good. I think the operational risk is probably one of the strongest of that side, because we talk about redeemability, and redeemability has to be there. If you're not allowing your investors to actually have that gold, a massive drawback, a massive draw of why people would invest in tokenized gold gets removed. If I can democratize gold and I can start buying in a fraction and build up those fractions and then have like a good amount, I want that gold. So the operational aspect of actually getting that becomes a problem. But yeah, I don't want to say that the risk has moved. The risk is both sides, and I think it's I think anyone that's telling you that it's not is being potentially untruthful. There is obviously a risk. There is no investment without risk. There is no new business without risk. What it is, though, is making sure that we mitigate it as much as we can and understand it and view it. And that's where blockchain becomes really, really powerful, because you can move it through and you can very clearly see where that gold is moving. So, yeah.
I have one more question for you, but I think we will reserve it for the end. It's again a very important question. But thanks very much. You alluded to regulatory aspect, and therefore it's the right time for me to invite our next speaker, Mr. Micheal Wharton. He's a director at AKW Consultant. He is going to take us through the regulatory and compliance and risk governance structures. Micheal is an expert in AML, CFT, DPMS, responsible sourcing, audit assurance, and tokenization regulation across UAE. He's got deep knowledge of DMCC, WARA, ADGM, OECD, LBMA governance structures and their intersections. He's an ideal speaker for regulatory framework, and he will walk us through the compliance requirements and the risk considerations in UAE and other geographies. Micheal, over to you.
Thanks. What's up? Good afternoon, everyone. Definitely thanks to the moderator and the other speakers for throwing light on the topic. Robert, of course, we're just talking about the different kinds of counterparty risks and legal implications, and I'll sort of pick it up from there. So this conversation on gold tokenization is actually taken a very good trajectory, starting off with definition of tokenization, then moving into Micheal's segue on the technology wrappers around that, and then Robert picking up on essentially how risks are managed and aspects on compliance. And it's a pleasure to be here because this topic sits at the very intersection of what you would call traditional precious metals, regulatory evolution, and the digital asset ecosystem. So I'm a part of AKW, and we work across the regulatory compliance space. In my capacity here, I've had the opportunity to work with refineries, traders, other entities in the DPMS sector, digital gold entities, even other regulated entities such as fintechs, exchanges, and WASPs across the UAE internationally. And from these engagements, one thing has become clear over the last 1 year. And that's where I think at the previous DPMC, Robert says a lot of people, weren't really talking about tokenization. Now there's a lot of talk around that. And tokenization is no longer just a technology mechanism. In my view, it's a regulatory and a governance transformation that's happening, requiring discipline, structure, and clarity. So when it comes to the regulatory landscape, let me just give a little bit of background, for the wider audience here, because this is where most operators either build a very strong foundation or unintentionally end up exposing themselves to risk. From a regulatory perspective within the UAE, tokenized gold can in fact be spread across various regulatory umbrellas depending on how the product is structured. So one is, of course, you have gold at some point, you have physical gold. So the first regulator would be some kind of a licensing authority like the DMCC, further regulated by the Ministry of Economy, governing the activity. In a sense, it is still gold trading with some kind of a technology wrapper. Of course, there could be various, I would say, modifications to all of that, but that's essentially what it is. And then, at least in the UAE, the token would also be treated as a virtual asset, especially when token custody or exchange services are involved. So WARA would become the relevant authority. quite more so because of the asset referenced virtual asset related rule book that has recently come out, the ARVA rule book. And then when the product resembles a security or an investment token, sometimes you could have that form of a gold token as well. Then within the UAE, at least ADGM offers a comprehensive framework for issuance and governance. So you could essentially have a platform where gold is vaulted under DMCC rules. The tokens are issued under WARA supervision, and you've structured investor protection under EGGM. So the UE is, of course, very progressive, but it requires accuracy on the licensing side. Misalignment between technology models and licensing models are not uncommon, at least from my perspective. And it's where one of the most common compliance risks take place. Robert mentioned about Singapore shaping up. So Singapore, I'd like to say the Monetary Authority of Singapore focuses on the economic substance. So interestingly, what I've experienced at least is that Singapore is not really concerned about the technology wrapper, and they're just concerned about the behavior of the token. They want to understand the economic purpose, the redemption rights, custody arrangements, and appropriate regulations fit in from that perspective. Of course, it's an evolving regime, so there's a lot more to it than just that part. But that's also a progressive side when it comes to real world asset tokenization. The US is also has a very scattered system. There's the CFTC, which may treat a gold-backed token as a commodity, but then you have the SEC, depending on the business model again, which depending on profit expectations or pooling could come in and regulate. And of course, in the EU, you have the MICA, where again gold tokens fall under asset reference tokens. They have requirements of reserves, audit, disclosing obligations, and so on. Irrespective of where you plan or how you plan to set up the operation of token issuance, regulators, I think, right now in this regime are broadly expecting four things. So they're expecting, of course, proof of reserves. They're expecting transparency around rights, redemptions, custody, ownership, process of redemption. Uh, Within the current scenario of the globe, they expect very strong AML CFT controls. Gold is already a regulated domain. Virtual assets is already a regulated domain. The combination of the two is bound to come under the requirement of robust AML CFT controls. And for gold tokenization, I think something that's very important, which a lot of operators don't think about necessarily at the beginning, at least, is the requirement to have structured and recurring audits. At the end of the day, the biggest point of friction when it comes to connecting gold and tokenization is building trust. And in order to build trust, having independent vetting in terms of structured audits is important. Inventory audits, balance sheet audits, as Micheal pointed out. So tokenization doesn't necessarily remove regulatory expectations. It sort of amplifies them from what I've seen, at least, of the various operators that seem to be making some kind of progress. I think for an operator, the first and perhaps the most underrated compliance risk is the legal classification. You can have two tokens that can be technologically identical, yet from a compliance perspective, they can be treated in completely different ways, depending solely on the economic purpose, the rights granted, the redemption mechanics, and how value is conveyed to whoever the holder is. So that's why operators can't rely only on the technology. Even if you have tokenization of warehouse receipts, being able to ultimately ensure that the issuance operator has the right kind of controls in place so that the tie between the token and that receipt is actually foolproof and tamper-proof is absolutely fundamental and paramount to this. And then we spoke about counterparty risk. So if I have my gold, it's my gold. But if I'm buying a token, you're introducing token issuance operator, you're introducing a vault, you may be introducing a refinery, you may be introducing multiple authorities, and the gold isn't kept with me. So from that perspective, I think there is counterparty risk, there is custodial risk. There is no such thing as a completely decentralized physical gold. Gold will be in a vault. The trust anchor is still a custodial institution. And what we look at is for tokenization to enhance that specific aspect. So I think, at least to begin with, that's something that I wanted to put across in terms of gold tokenization. There are many challenges. There's AML CFT risk, there's cross-border challenges. From an AML standpoint, tokenized gold introduces risks that regulators already view. There's rapid cross-border transfers without a corresponding physical movement. There's layering because you can have multiple wallet hops. You can have the use of privacy tools. For people who are a little aware, there's the use of mixers. You can have peer-to-peer transfer where you can have systems where formal onboarding is bypassed. And then, of course, there's also the risk of redemption arbitrage, where you can have a digital entry, but then you can redeem physical gold at some point. So controls are needed definitely to be able to overcome such risks. Banking and cross-border compliance challenges are persisting. The gold sector is already considered high risk by a lot of banks. It's difficult to get a well-functioning bank account. Platforms also would need to demonstrate wallet screening, source of funds checks. Gregor, I think, mentioned the travel rule compliance. If they're looking to gain some kind of banking, support overall. So those are some points on the legal side. Of course, if there's any questions, more than happy to take them.
Thank you, Michael. That was really nice. You stress upon the expectation of the regulators, proof of reserve, transparency, AML control systems, and the chain of custody. One very basic question: how does the regulator look at tokens? Does it look at it as a commodity or a security?
See, I think a lot of this depends on the business model. This is actually a really good question. So you could have a gold token that purely represents a certain specific physically allocated value of gold. And we've engaged with regulators quite a bit because we're working on certain aligning projects, and we've engaged with WARA and ESCA, at least in the UAE. And the consensus is that if it can be established that the token is just being a representation of physically allocated gold, then it would be treated as a commodity. But there's a lot of things that you can do with the technology. The whole point of tokenizing gold is to do things with it. So you can stake your gold and you may be able to earn a return, which is sort of like lending your gold to another party. But that also brings again counterparty risk. So that's a different story again. Or you could start using it as a payment mechanism. I want to take services of somebody. I say, let me do something. I have this this token backed by physical gold. Let me transfer this token to you. So then that no longer becomes gold. It starts becoming, it's used as a payment mechanism. So what's happening over here is there's a securitization that's essentially taking place. So if controls are in place to ensure that the gold token is just a sort of a map with physical gold, then I think, yes, regulators would look at it as a commodity. But at the end of the day, that would be a very boring project, right? I mean, if you're not earning from your gold in some way, or you're not utilizing the technology wrapper that's around it in a manner in which you can get more value out of all of this, then that's probably not, you just might as well go and buy gold or jewelry. So if you try to do more, you expand the business model, and then regulators might increase their purview and, of course, expect more controls. which are not akin to just a commodity. But the simple answer is it depends on the exact business model.
If I can add to that, because I think Michael has been giving a very good overview of things. In Singapore, when we started our token, it was back in 2016, 2017, it was going to be regulated under Ministry of Law. And the Ministry of Law essentially saw it more like a commodity, essentially. And you had to do AML KYC when you have a deposit and when you have a withdrawal. But what happens afterwards essentially was not concern of Ministry of Law. But then MAS, the central bank, basically started saying, well, but it could be used as a form of payment. And because it could be used as a form of payment, it was then decided that it will be taken out of Ministry of Law and it will become going under MAS, it will become a security. And if you're a security, basically you can no longer be freely traded. And so the token went from being a public token, which was the original plan and was permitted under the regulatory regime, and that basically broke apart. And so the business plan really sort of didn't work anymore. So those were the side companies that we had back at that time. But it was exactly the kind of risk, that we experienced of a regulator having one view at one point, then changing their mind and making the project essentially obsolete. So that's the kind of risk that is involved with this tokenization, and I very much agree about the statement that it's really amplifying the regulatory sort of risk, because regulators are a bit worried about these things because they don't quite know all the implications of it, and they tend to go on the safe side and change the rules, quite frankly. And,
Michael, can you give us what is the regulatory framework in UAE? Who regulates gold? Who regulates gold tokens in UAE? Just to get an understanding.
So in the UAE, if somebody gets into gold, essentially what they need is a precious metals trading. Non-manufactured precious metals trading is the actual licensed activity, and they need it from a licensing authority, which I could say there's two major licensing authorities that are quite well known. So one is the DMCC, which also has a brilliant vaulting infrastructure. The other, of course, is the Dubai Economic Department or the mainland. And then sitting on top of all of this is the Ministry of Economy that looks into, I would say, AML, CFT obligations, regulatory obligations that need to be undertaken by gold trading companies, because gold trading companies come under the category of being DNFBPs, or designated non-financial businesses and professions. So that's the landscape just when it's purely from a gold perspective. Let's say if I just wanted to do gold trading. When you move into tokenization, there is a regulatory regime taken out by the Virtual Asset Regulatory Authority. There is a ARVA regulation. So essentially it comes under the Virtual Asset Regulatory Authority. Gold tokens, however, are not something that let's just say in theory and in paperwork it's all absolutely there, but when it comes to the actual practitioners or an operator that's there in the market, there are players that are trying to play catch up at the moment, but we're very close to getting to where we need to be. There are projects that have been announced. There's a lot of excitement in the air. It's just that if you wanted to buy a UAE native gold token today, that's approved by regulators. At least I'm not aware of one. If somebody has one, then they could point that out. But I'm not aware of one within the UAE, a UAE native one. There's a lot of them across the globe, which of course you can still trade from within the UAE. What I'd like to quickly touch upon, I think one of the questions also is about the legitimacy of the ownership and the vaulting, and how that can be ensured. So I'll put it down to three questions, even from an expectation of a regulator's point of view. There's governance, there's audits, and there's transparency. So what would strong governance look like? It would begin with reserve governance. So there should ideally be, and this is, of course, a little bit of an opinion as well, based on projects that we're working on, but There should be daily reconciliations between the token supply and the vaulted holdings. There needs to be real-time proof of reserves, which are tamper-proof. Ideally, there should be inventory audits or physical audits conducted at least monthly or weekly, and there's no doubt that there should be segregation of client assets. Your operator or your vault should not have direct access to client assets because those can be misused. If a platform adopts these rigors in reserve governance, and of course, they also follow all the rigor that is associated with traditional gold, like, for example, the expectations from LBMA, DMCC, OECD, and FATF frameworks, supplemented with virtual asset controls, then I think they have good reserve governance. Customers must be protected. So the customer or the investor, the purchaser, needs to have full clarity on the redemption rights, the fees. Somebody mentioned insolvency treatment. What happens if your operator suddenly says they go bankrupt? How do you get your gold out from there? Segregation of assets, the custodial responsibilities, uh, borrowing from gold ETFs. There should be a lot of transparency on the net asset value or the NAV methodology, because sometimes if you want to keep the market say, you just want to keep it transparent. You want to talk about how much the spread is. There should be clarity on the NAV value, and there should be a clear reporting mechanism to reduce any kind of information asymmetry that may exist. So I believe that if there is a practitioner and an operator with the right kind of technology frameworks, like Michael so mentioned, in terms of the technology wrappers, with all of these reserve governance and compliance protocols in place, both on the tokenization side as well as on the gold side, we will have a really strong player in the market.
Thank you, Michael, for the wonderful suggestion. We stop here with you, we will go to learn more about how the gold platform, Oro Labs I'm referring to, is doing in UAE. For that, it's my pleasure to invite our last speaker, Mr. Usman Saleem, who is the founder of Oro Labs. It's a tokenized gold platform, one of the fastest growing tokenized gold products, and his focus is on consumer adoption, settlement flows, fintech integration, remittance-based tokenized gold use cases. The use case part we will stress more as we talk to him more and understand. Practical experience in token minting, redemption, and market liquidity. To learn more about what Mr. Usman is doing, over to you, sir.
Hi, thank you so much. I just wanted to before I push out that I don't want to say we're based out of the UAE. There's obviously regulatory questions, challenges around that. So we're registered elsewhere. But yeah, look, I think it's been so awesome to listen to everybody who's come before me to touch upon both the technology side, the regulatory side. I think for us setting it up, this has been quite a bit of a task. But I would like to say that we're entering this world where tokenization is going to become easier. It's going to become, no pun intended, like a commodity. And you have obviously great businesses out there who are helping other issuers take their gold to market and just essentially any real world access tokenization. And we sort of always knew this, that we're doing the hard work to kind of figure out a lot of stuff, because when we started building this, there was not a lot of clarity. And I think even from a tech point of view, how do you approach this? I think where we're getting to a point where this is becoming much, much more simpler. And for all of those who are a bit more crypto native, probably are aware of how easy is it to launch tokens on launch pads now, right? And I think it's going to be much, much more easier as we go along from whether any sort of real world asset token. And what that means is that specifically, I think for gold, this is very interesting because gold is one of those few asset classes where I think if you look at two, let's say if it's a real estate asset and two different assets, you have some element of difference. I think with gold, when I kind of look at probably the most best in class gold tokens, they will have very, very, very similar properties in the sense that they'll probably all be LBMA or DGD gold. They will all be to some extent, probably everybody's going to be stored in Brinks. They will all have a great third-party proof of reserves auditor. And so there's some element of fungibility. And so when you have users who are effectively choosing between these different gold tokens, which pretty much smell the same, are like the same, I think it's going to be about distribution and the use cases. And I would believe that if there's 20 gold tokens that are going to come next year, who ends up winning, right? And it's just distribution liquidity. Those are the two things. And so when we decided to build it, it was very much simply about how are we solving, because I don't think the end user and the end marginal user for gold is not a crypto native user, right? Whether it's the end marginal retail user or the end marginal institutional holder of gold, you have to solve the problems that they're facing. And with gold, it's always been access, yield, and credit. The fact that it's not as easy as accessible in large parts of the world, largely due to local, market dynamics there. Number two is gold is inherently not yield bearing. Crypto rails allow for yield generation on most assets, and which is very interesting for gold because it's a traded asset, one of the largest traded assets, and that leads to an interesting yield profile. And number three is credit. We see that with the LBMA launching their digital gold pilot recently. And lastly, because how can you unlock liquidity for gold and how can you more effectively use gold as collateral? And so those were the three problems that we wanted to solve. And when we started building a tech out, we're fully on-chain issuance platform. The minting and redemption all happens on chain. We've kind of, taken a lot of it obviously takes a while to build that infrastructure out, because not only do we have sort of the ability for people to buy a gold-backed token, but then the ability to earn some element of yield, whether through staking or whether through some of the other DeFi front ends that we have. We also have an oracle that I think, Micheal pointed out, where we have integrations with two live oracles, which essentially determine the trade, the price of the trade. So essentially, you're not also just kind of relying on us as an app or as a platform to sort of trust us on the price of gold. We have got trusted sort of intermediaries or trusted integrations that are sort of supporting that price oracle. And that's key, right? Because ultimately, I think Micheal pointed this out, that gold is effectively, you can never be 100% decentralized. But I think trust, how can you sort of build out trust with these different elements? And it's about working with the right counterparties, whether it be at the regulated level, working with the regulators to ensure that you have the right protections, whether it be at the whether it be the different sort of partners you might work from a technical point of view. So making the right choice of Oracle partners, making sure that you have also the right controls, right? And I think, I want to sort of touch a bit upon, we're just going through a very intense process with a third-party auditor, and this is one of the world's largest audit firms that is auditing our reserves. And this is super interesting because, one would hypothetically think that they're only basically kind of come in and basically be like, okay, 31st October, this is the amount of gold. 31st of October, this is the amount of gold supply. Let's issue the report. But the process is very intense. The process all the way goes from, hey, let's talk about your controls. How do you mint? How do you redeem? Your minting redemption, is it happening through one single person, one single wallet? Is it happening through three different wallets? What are your internal controls like for that? So it should not just be that one single person like me should be able to go and mint these gold tokens. You need to have the right controls to make sure that it's effectively operating like a financial institution. When have you bought the gold? And when did you mint the gold tokens? Because it cannot be that I minted the gold tokens today and then I went and we acquired the gold tomorrow. There has to be a process. Which entity paid for the gold? And what is the relationship there? And then, so we're going through this entire process, which is amazing to see because we've obviously done things the right way from the start. But it's, I think, which is what, again, right? So when you then get a stamp or a monthly report from this very reputed counterparty, I think people look at that and they're like, hey, okay, this company has done the right things. Because the reality is, if you're truly crypto native asset of Bitcoin or Ethereum, you are able to see everything on chain. I think with a physical asset, there is going to be some element of trust which will have to be there. And as a company, our tech, our platform, all our sort of mechanics need to effectively imbibe the trust in the end user, and it takes time to build. I think it's not going to happen. It's not going to happen overnight, but we're getting there.
Thank you, Usman, for taking us through the entire life cycle. That makes it interesting. You would have faced multiple challenges at each stage of this life cycle of this tokenization. Which one was most challenging for you and why?
Um, Honestly, every process, every single stage has been really, really challenging. Even once the token is out there, you're like, okay, this is. I would say if I had to sort of, I think finding the right audit firm to audit, right? Because you will have a lot of, let's say, third-party professional firms who can probably produce a proof of reserves audit, but maybe they're not so well sort of acquainted with crypto or crypto rails, because they'll also have to independently see the gold supply and whatnot. So, and they need to understand the mechanics of how we're running the business. So I think that's definitely difficult, because you go through a roadshow and you're going to speak to 10 different firms, and everybody will tell you that they can do it. But then when you speak to them in the first 30 minutes, you have an understanding, actually, they don't necessarily understand the mechanics of that. So I would say that was very challenging. I would say, actually, working with the right market makers as well it's a process, because ultimately either you work with a very, very reputable, established, expensive market maker, and the issue with the fundamental gold token on its core is that unless you build out an insane amount of distribution compared to existing crypto tokens, it's not necessarily a money making machine from the start, or it's not really generating the right economic value. And so you can't really. So I think finding the right market maker who you can work with, who can support you with on the secondary market liquidity, make sure that your tokens are sort of trading in line with the price of gold. People are able to buy the tokens at the right price and stuff. So that was definitely one of the other challenges that we had.
Thank you. That's been very frank. Thank you very much.
Actually, one more piece was, I think a lot of guys
Yes.
touched this already, but figuring out the legal structure is super important. It took us a while, because I think there's so much out there, and there's still, I think, whilst these different frameworks and are getting developed, it did take us a while. We had one law firm that we subsequently got rid of, and then we got another one, and so that process delayed us 2 to 3 months, because I come from a traditional finance background, and I generally have, I would say, a pretty solid understanding of how legal structures work. And so when something wasn't making sense to me, and I've looked at very complicated financial structures, I'm like, oh, if this is not making sense to me, how do we sell this to the end user, whether it be retail or institution, right? It also has to be, I think there's a lot of complications out there and a lot of complicated stuff. I would say, gold tokenization is one of the most simpler tokenizations that can happen. And so we don't need to necessarily complicate it. And I think working with the right advisors, working with the right lawyers is also a challenge, but we've gotten there now.
Excellent. So you are in a way supporting what Robert has already mentioned. Choosing your right partners is very important, and that's one of the key things, especially in trying new things, such as real world asset tokenization, even with standardized assets such as gold. I want to talk about another very serious part, which is chain of custody. Uh, what happens to the chain of custody and integrity of that when you move from one chain to another chain on different wallet? How do you ensure the integrity?
I think ultimately, um, the most important thing is ensuring the chain of custody of the physical gold, right? Because ultimately, the physical gold needs to be acquired in the right manner. You have to work with the right compliant authorities and counterparties who are helping you acquire the physical gold in the right manner. Once it's vaulted, the reality is that we are, especially for gold, it's one of the most traded assets globally, right? And there will be ways where this asset can be, people can trade this asset to us through our primary market. It's very permissioned. Um, it's all KYC'd, right? Or KYB, and that's important. So when they're redeeming with me, through my primary market, I know who they are. But there can be instances, and we see some of the largest, biggest tokens out there, Paxos Gold and Tether Gold, which have almost 1.5 billion of of assets under management. You are able to trade these tokens in the secondary market. in a permissionless way. And that will be, I think, part of the process as well. I think the most important thing is, right, when you speak to regulators and we speak to other counterparties, is that the interaction between the on-chain and off-chain world, when that is happening, that needs to happen in the most compliant manner. And so effectively, if somebody is redeeming through me and then I'm interacting with the off-chain world, I need to know who they are. If somebody's buying through me, similarly. What is happening maybe in kind of that ring fence, let's say, in the blockchain world, could happen in a permissionless manner. And I think there's that important distinction as well, right? Because ultimately, you want this asset to move as fast as possible. You want to be able to get distribution. And if you certainly try and put X 10,000 guardrails, which might not even be necessary, that can also limit the distribution of the product.
You know,
Thank you.
if I might add
Yes.
to this, I mean, we spent about 100 million Singapore dollars, maybe 80 million US, to build these vaulting facilities. We spent 15 years building trust as well as, you know, also proof of reserve system. So the trust stuff can sort of be handled. I think the one thing we haven't discussed a lot about the problems of gold tokenization, besides the legal part, is monetization. I've spoken
Exactly.
with some of the founders, you know, of Paxos or the gold token, and they're having the same issue. I mean, if you look at Paxos or Tether, they have a fantastic business model because for the most part they have stable coins based on the US dollar. And the US dollar is a depreciating asset. And you know, it becomes worth less and less over time. But there's an interest being paid, and that interest goes to the stablecoin operator. And Tether has about $200 billion now, and they're making 8 billion a year, you know, through the system. But what we found when we did the gold token is we tried to charge a storage fee. And it was somewhat complicated, but we managed to do a way to have our on-chain storage fees in ERC20 of 25 basis points per year. But the problem is the crypto community just didn't accept it. They don't like the idea of something being taken away. But if you look at the capital expenditure of having gold, it has to be insured. You have all of these other things. You end up with an asset which costs something. And so it's the opposite of dollars, which are paying an interest, and you're getting something. So you have to monetize it in a different way in order for it to make sense. And that's really one of the big challenges, which, you know, are still haunting both Paxos and Tether. I mean, they do have an idea that they might just do what the gold ETF is doing, like SPIDER, you know, the GLD, which is that you just reduce the amount of gold backing each unit, basically. But then that creates other problems, and that creates a trust issue in some ways. So that's really one of the biggest concerns.
Gregor, thanks for
I'd agree.
I wanted each of us, Micheal, so you manage 190 million. How do you address the cost issue, especially what Gregor mentioned just a while ago?
Just to clarify, we Tokenyze, we serve as the tokenization agent. So we do not own the metals behind the scene. It is another entity that actually owns the metal. But just to touch upon this very, let's just say, business, you know, logic and problems over here, and how practically the entire industry solves it. At the end of the day, physical custody, as provided by Mr. Gregor, for example, your company, you know, and other vaulting locations, you know, no questions, you know, has a cost to it. It takes money to ensure, you know, the vaulting obligation. It takes money to run the facility. It takes money to inspect. It takes money to transport everything, right? Now, there's a cost to it. There's no question about it. And but however, you know, that cost can be so-called paid for by parties that may be unknown, you know, to the eventual end holder of the token. The end holder of token may simply own the token. They may not understand, you know, how values may either basically slip away from them, or the fact that, you know, they may be willing to pay for other fees that effectively will indirectly cover the cost of custody. So let me tell you one example. If you actually were to look at the original PAX-G token from a smart contract perspective, you will see that they have very, let's just say, let's just say very smart, slip in something called fee recipient within the smart contract. And what does the fee recipient, function do in the smart contract? Effectively, they have the option. They did not use it, but they had the option to charge, 2%, up to 2% fee every time when there's a transfer from a wallet to another wallet address. Now, that fee, sure enough, can go back to the issuer, which is the party already paying for the custody. I'm not saying that they did actually use the function, but there are ways to cover the custody costs, in other words, But in my opinion, the Web3 experience today is that they don't expect to basically hold a token and be charged and have to pay for a bill every month. That's not exactly how the business relationship works. The way it typically works is that the ERC20 token holders effectively either doesn't exactly get the value, for example, at the fair value of London. They may be paying, the price, of London, but getting the quantity slightly below London, which in effect, can be used by the issuer to pay for the custody fee. So that's my kind of short answer as a teaser, for the audience and the speakers over here. There are many ways to achieve the problems.
Robert, quickly, how do you address the cost? Then I'll come to Usman.
It is like everyone said here, it is one of the more difficult parts. Now, we know that everyone in this market, everyone takes a tiny little skim on everything. Everyone needs to be paid to do the work they're doing. However, what you end up with then is if there are too many counterparties there or they're charging a bit too much, you end up buying tokenized gold at like a good amount higher than you can just buy a gold option or physical gold. And then it comes to the point of the value add becomes not so much of a value add anymore. I'm actually more akin the lines of there needs to be an additional generation of yield for that gold, and then you can just take a cut out of that. So once that gold is tokenized, what are you doing with that token? Are you now using this as a collateral into a lending pool? You're now getting paid on chain for that. Now, if someone's getting paid, then you can just take a cut of that payment for running the whole shebang. I think that's realistically, it's one of the only ways it works. You can take a small skim at the start for like setting it up. Like Michael said, you can take a cut for transfer. And frankly speaking, that's whenever we transfer assets, we take a small skim on that secondary market because we are, like Michael, we are the issuer in this scenario. But if you want to make any like proper money, you're making that token work for that investor. You're giving them additional yield, and then you can just take a piece of that.
Right. Any use cases which is popular anywhere in the world currently? You just talked about lending. Like you can give us some examples, because increasing the yield at the end of the day is the answer to dealing with cost. Agree.
Lending, I would say, is the main example, and not just with gold. I would say with near enough all commodities and near enough all RWAs. You're obviously invested in gold and you're going long on gold, so you're seeing appreciation of your asset. That's the same as physical. What tokenization brings is the fact that you can have your physical asset stored, but you can now use that virtual asset to now do something about it. I mean, we all know like borrowing against gold is massive industry. When you get married, your wife, she gets given a load of gold from in-laws, from family. What happens? Straight afterwards, that goes, you borrow against that, you start businesses, you start running it. That is normal. We know that borrowing against gold is there. What this is borrowing against gold in a much safer way, because you're never actually giving away that gold. You're giving the right to gold, but that gold is stored in a secure manner. So I would say, and I'd welcome anyone else popping in on this if they got a better idea, but I'd say lending is the main one.
Well, Robert, lending is an option, but you don't get a free lunch. So if you do lending, you're going to incur some risk with it, or the holder is going to incur some risk, and so that has to be borne uh, somewhere. But it is an option. It just becomes a different instrument from just plain old gold. Um, there might be another way of doing it as well, which is to essentially, or coming back to the transaction side, where you take a transaction fee. That makes sense, but there's just one problem in the crypto market because in theory you can take some ERC20 wrapper, right? And you can essentially create a derivative of that gold token with some clear rules which everybody can double check so people can trust it. And then you could just trade the derivative. You see what I mean? So you could have a gold token A, and then somebody comes along, a third party, and just buys a whole bunch of them, puts up some derivatives and charges a lower fee or something and trades that one. So that's one way that, at least in the public markets, you can bypass it. Uh, but yeah, lending could be one option. But again, it changes the risk profile of the whole thing.
What about, can we use tokenized gold as a liquidity pool for institutions?
Yeah,
Do you
I
see?
mean, I wanted to add something there, right? How we're kind of thinking about it is, I think actually it's super interesting. There's some learnings. When we started the business, I thought it was all about yield, and we have a source of yield that is not on-chain lending. There is, we're involved. We're plugging into off-chain gold leasing pools, but the reality again, Gregor, like there is no free lunch. If you're earning yield above the T-bills rate, you are taking some risk, and that's the reality. And I also don't think that anybody, any institution or anybody is going to want to tokenize an asset if they're not getting any additional benefit from the existing TradFi world, right? And I think with crypto, obviously, there's two aspects. There's that you can earn yield from liquidity provisioning. You kind of look at, I would say, both Paxos and Tether's existing pools out there, Uniswap, they're earning healthy yields. The beauty of gold is, though, is it's a very tradable asset, and people do trade on the price of gold. And I think that's super strong. I think the other piece is, again, the lending, being able to borrow against the gold, use that as collateral, also generates yield. The healthy thing, though, that I saw is that if you have a primary market, how do you generate enough volume into the primary market? We were pretty surprised that that our existing gold token, we increased mint by a little bit last month, but the existing gold token had a lot of amazing volume, and that actually meant that the one-off cost is, we're making a one-off minting and redemption charge, but then if there's consistent volume through the pools and consistent volume through the primary market. So a lot of what we're actually building next year is how do we generate sufficient volume through the primary markets, whether it's through working with different B2B partners to enable fintech integrations, versus I would say the existing, because you look at a Paxos Gold, right? And a Pax Gold, I think, and a lot of these golds traded really, really well over the past 6 months. But the underlying issuer is not really seeing any benefit of that volume because the token is issued, the market makers and the exchanges are seeing the benefit of the volume. But if you're able to build out a lot of decent volume at the primary layer, that I think is a great benefit, and then obviously yield. So I would say we're focusing both on transactions and yield. I do think there is some element of risk, right? Even if you're getting yield through liquidity pools, there's always going to be a small risk of smart contract hacks, and that's just the reality, right? Again, there's no free lunch. So if somebody tells you, hey, you're going to get yield on gold without any free, that's the reality. There's nothing for free here. But I would say it's about just building very substantial business models and use cases. That's how we're thinking about it.
Right, thanks. We need to go really fast. There are some questions, and I also have some questions. Usman, quickly, can you take on this on taxation? How gold tokens are taxed, capital gain, short term, long term, cross border taxation to Micheal, if you want to take quickly.
I think maybe it's Micheal. My understanding is jurisdiction by jurisdiction is treated like any other crypto token out there, but that's my understanding.
It mostly follows that perspective. It's based on it varies from jurisdiction to jurisdiction. Of course, when we say jurisdiction, there's two paths to this. There's one is in terms of where is this token issued, and then there's also a residency jurisdiction. I mean, from a taxation perspective, so much depends on the laws within the country which I'm actually filing my tax return, and how they would treat any income, any redemption margins gained from gold tokenized gold trade. So I won't say there's a simple answer to this. It's literally a case by case answer. If somebody comes with a US passport and they ask me this, there's a different answer to this. If somebody's in the UAE trading tokenized gold, there's a completely different answer to this. It would depend on the jurisdiction to which that individual has his purview. But I mean, the short answer is exactly what Usman said. It would vary according to jurisdiction.
How is it, Gregor, in Singapore?
In Singapore, we don't have capital gain taxes, so it's very easy here. But yeah, it's a very complicated thing. Everybody has to figure it out themselves and ask the tax advisor, basically.
Robert, any comment on taxation or?
I live in Dubai, so no one wants to hear my answer on that. It's nothing.
Right. Let's take the next question from Vikram. If the transfer is on the blockchain and the redemption is at the vault, does the smart contract transaction will be sufficient, or what legal rules will be applied?
So again, over here, if I had to add, I'll say it's so much about your governance, audits, and transparency requirements. So if there's redemption essentially happening at the vault, then that needs to be documented, through whatever governance protocols that are put in place. Then I think I'll also add in terms of cross-chain interoperability. So that's one area where I think it's already, it's already been addressed quite a bit, but that will, in my opinion, challenge platforms also to maintain a single authoritative reserve record, even as tokens might move across networks. So overall, gradual mass adoption, institutional adoption, for example, might depend more on whether platforms meet standardized custody, reporting, compliance requirements. I think one of the main challenges right now is where we talk about governance requirements, compliance requirements, but those are also a little scattered across different platforms, across different regulators. There will be a time where there'll be more standardization across all of this. And then tokenization, there might come a time where tokenization it won't really replace traditional bullion markets, but it'll extend, continuous global 24/7 built on a strong regulatory foundation.
Thanks.
If I could just,
Coming back to this. Sure.
if I could just add on to that smart contract point. I think we always talk about smart contracts because we always talk about having a self-custody token which is fully tradable, and the contract is what actually governs how that right is portrayed. But what I see is that lots of investors into tokenized commodities, they go through a platform. So they will have like a broker dealer, like a distributor. Now, if that broker dealer, that distributor, they don't necessarily need to have smart contracts on those tokens, because there's the governance of that regulated entity which is managing how that asset is moved. And that actually makes the redemption side far easier, because it's not that the vault has to know whatever tokens are being created, and anybody can just go to that vault and say, hey, I've got a token here, look at my phone, I'm going to burn this and you're going to give me gold. It's going to go through that licensed broker dealer that, as they're already a distributor of gold, has that relationship with that vault, with that custodian. So the whole process for that redeemability becomes a lot smoother. Now, there can obviously be smart contracts involved as well. I think it's just important to not forget that there is off-chain governance involved in any of these projects as well. We all love being crypto native and running everything on chain, but when we're talking about traditional markets, they want some off-chain structure. They want some security that they're more used to. And I think there's ways that are much simpler that we can use in these markets to get that money moving and that gold redeemed.
Yeah, maybe I'll add to that because when you're a vault operator, you're essentially dealing with specific clients. You have to onboard these clients and you have to check and assess whether the risk of onboarding that client makes sense. So, if, for example, if we have companies wants to tokenize gold, the first question is, well, is this going to be legal under Singapore law? Because even though we are not tokenizing it ourselves, we are a service provider to that company. And we sort of have to understand and make sure that the AML KYC requirements are sufficient to give us, that confidence that we can have that clients. Because what we don't want to do as a vault is to have some clients which end up getting involved with its drugs issues or terrorists or something else or money laundering, and then the bad news end up reflecting on the vault. And so that's always a major concern when you're dealing with vaults and it's or other entities, financial institutions, and so on. And that's essentially where one of the difficulties come in. And again, it comes back to regulation.
Great. I'll quickly move to the next question. How does one create a legitimate ownership structure in case of gold tokens backed by the physical gold? How does one show transfer of ownership of the underlying asset and enforce the same? I think this has been answered quite extensively. We've covered regulatory aspect, practical aspect, the role of vaults, various risks, and so on. If anything left further needs to be addressed, I'll start with Robert.
Yeah, I would just reiterate on the structuring of ownership. So whenever we look at minting tokens for gold, we always look at tokenizing the warrant, and that is then the legal ownership for that gold. So everyone does it a different way, and most of them give a solid amount of ownership of that gold. Some give a view to the price of gold. But I think everyone here, we're talking about tokenizing the ownership, and we do that on a warrant. So that warrant is the receipt you get. So if we take tokenization out of this, I go to a vault and I want to put gold in, I give them gold, they give me a warrant. That warrant is how I get my gold back. Now, if I do this on a tokenization form and that warrant becomes a token, you use that to get your gold back because that is the ownership. So I can't go and get that gold out even though I put it in because I don't have the warrant anymore. I've tokenized it and I've given it to someone else.
So directly issuing tokens on the gold itself. The other one, what you said, is issuing tokens against the warrant. Right. What's the most prevalent practice, Gregor?
Well, I think, when you go into nitty-picky part of it, there are different type of quote-unquote ownerships. There's a beneficial ownership and there's a legal ownership. And I think in most cases for tokenization, that gold is going to end up being on the balance sheet of whoever tokenizes it. And so depending on your definition of what ownership is, you might consider it or not consider it ownership. Also, as a vault, ultimately we are going to do whatever, say, our client is telling us to do, not a client of the client. So it is different from somebody owning a bar and storing that particular bar and having, say, real legal title ownership as opposed to beneficial ownership, which means that he's entitled to the benefits of what's going to come out of it. But so there's these two sides of it, and it really, you have to more or less find a balance. If you want the convenience of a fungible token, you have to give a little bit something up, and I think beneficial ownership, is kind of what you're doing, and there has to be some way for that company to make some sort of profit to pay for everything. So everything is a little bit of a give and take. But I think as long as said beneficial ownership is well structured and it's documented and you have the transparency and everything else, it kind of makes sense. But that's sort of my message, where when you really drill down into things, ownerships are different kinds of these, essentially.
Usman, how do you do it?
I think for us, it was super important that we have a bankruptcy remote ownership structure, because I think the worst thing that can happen is that whoever owns the gold or whoever owns the warrant, that is not sufficiently ring fenced from the rest of, the reality is, what the token holder wants to know is that tomorrow, if your company doesn't exist and nothing exists, what happens to the gold and who owns the gold? And so we have a foundation set up. That foundation essentially has ownership of the gold. It's a bankruptcy remote with and that foundation then has a relationship with the token holders via agreements, etc. That it's representing, that this gold is representing the gold of the token holders. So that's how we've set it up. I think Pax has something similar as well. Don't know too much about tethers, but yeah.
Got it. Thank you. Vikram's question again. Let's say we give the holding rights to the vault, and how will they take it as per the reserve, or let's say fixed deposit, or for getting more interest from the market as compared to the conventional method till now? I'm not so sure about what he wants to say. If any of you have understood that question, maybe you can
So
answer,
I'll
or
just
we go ahead.
chime in continuation to the previous, and I think I can understand what Vikram is trying to say. There's two parts to it.
Okay.
Everybody made it very clear that, of course, you set up a structure, maybe a foundation or some kind of a structure where you try and make that structure bankruptcy proof. But I think one of the best ways to ensure legitimacy across ownership is to actually have a regulator directly involved as well. Robert some time ago spoke about how they did work with the Dubai Land Department, for example. So that is your regulator when it comes to property. So if you have a regulator issuing a document, say alongside the vault, alongside some other entity saying that you are the owner of so and so asset. So in the UAE, it could work out, and probably this is what will happen also in some time, which is a DMCC or a UAE ministry owned vault would have gold, and then a token would be issued on the back of an ownership document, wherein the ownership is directly linked to whoever the owner of that particular token is on behalf of the regulator itself. So that's the strongest, because it's all about your word against my word at the end of the day. I'm saying it's in the vault, the operator or the vault issuer says no, it's not in the vault. I mean, you don't want to come to that kind of a situation. So if you have a reserve bank or you have a governmental entity in some way tied into a project, and I think it secures it the most. On the other question, in terms of how things could work as a fixed deposit, it's basically the interest yield aspect. So it's already spoken about multiple times. There is no free lunch. As soon as you bring a yield bearing aspect in, you do introduce some counterparty risk. Those can be managed to a very good extent. I think something that uh, I would like to touch upon when we talk about this yield bearing aspect and whether we want to introduce counterparty risk or not is, it's a fiduciary responsibility of an operator that issues tokens, gold tokens, to educate the investors, specifically if they're catering to retail investors. Education is actually the key word over here. As an operator needs to ensure that there are enough touch points with a retail investor to educate them on the fact that if they are going to be opting in for some kind of yield bearing mechanism, then they are aware of the counterparty risk that they're getting into. For some investors, that would not be worth it. They would just want their gold to be physically parked somewhere, and they want to just gain on the gradual appreciation of that specific asset. For some investors, getting a yield is very important. In the end, it should be their view of how things can happen. At the end of the day, even when we place money in a bank account, we need to understand that nothing is 100% secure. Even banks are insured up to only a certain limit. And if there's any kind of bankruptcy that happens for a financial institution also, there are limitations that are there. But as long as the education aspect is passed on, things are made transparent, things are made clear, the governance structures and internal controls are in place, the ownership rights of a customer, as well as the linkage between vaulting partners, operators, custodians, and the ultimate customer, that would remain quite transparent and clear.
We have minutes, so I want very quick answer. Price discovery on these platforms. Uh, let's say like on a Saturday or Sunday, what happens, Usman?
I think it's pretty interesting because this is one of the very interesting use cases of the existing big gold tokens out there, where if people have a sense of, okay, there might be some events happening on Monday or Tuesday, they can already start taking positions in that. I think that's super interesting. We also see there's a huge perpetuals market in crypto, right? So people are able to long and short on gold as well on the weekend. So that I think is a very interesting phenomenon to sort of see, hey, where what people are thinking about the asset. That being said, it's also, we have to take it sometimes with a grain of salt because the true bullion traders are not there on trading on chain, right? So it's like to sort of say, hey, oh yeah, this is where Pax Gold is trending this weekend, to say that's really going to happen in the market on Monday. Probably not, because we know that the gold markets don't function this way. So, but I do think it's one of the best things about tokenizing the asset, but whether it tells us something or not, I'm not sure.
And the other question, has any VARA regulated entities launched gold-backed tokens already? Have heard about property tokens, but has there been any gold
So
tokens?
it's
My
in
question.
process. It's in process. I mean, there isn't
Right.
you couldn't buy a VARA regulated entities gold back token at this point. I mean, let's just be very candid on that.
Right. I stop the questions here and I want final comments from each one of you. It has been a great learning for me and most of us here. You have traveled so far, you've had wealth of experience. Where do you see this product category or the market itself, opportunity itself growing in next 3 years and 5 years term? Who can go first? Maybe Greg.
Well, we built our business around the ideas that we're going to have a systemic crisis in the United States and that the US dollar is going to get into trouble. And I think when that happens, every asset which isn't the US dollar is going to be seen as something the United States might not want. And the problem with a gold token is that you can always be very easily be attacked because, if you take Ethereum or Bitcoin, it's ethereal basically. There's nobody you can really go to. But a physical gold vault is always there to make a claim against or embargo or make demands and so on and so on. So my gut feeling is that we will only see a truly large game-changing gold token system after we're going to have a US dollar currency crisis and after we see a big change in the world and we need something where trust is very, very low and we want to have a new kind of currency which is backed by something like gold. So my point of view, based on my experience that I had in the last 7, 8 years trying to build a gold token, I've kind of came to that conclusion that in many ways I'm sort of waiting for the world to change.
I am.
Yes.
I think we all who are running such projects wait for this. Well, not wait, because I mean the world's going to be in a bad position. But I'm more bullish, if is the right term, on the current what I would say trends of users wanting to access gold in a digital form. I think when we think about just tokenization, sometimes we box ourselves in. The reality is this digital gold category is growing really fast. users all around the world, specifically retail, are wanting to access gold in a digital form. And that's something we want to enable. And I think that's a very good near-term sentiment that we want to build for, especially in countries where people cannot access gold digitally at all. And that's a large chunk of the world, right? So I'm really excited about that. I think I'm also very excited about, when living in the UAE, if you wanted to borrow against your gold today, you pay around 15 to 20%. That is crazy if you think about it, right? And this is one of the biggest gold markets in the world. I'm very bullish on the near-term sentiment to be able to unlock utility for the existing gold out there. I think this will all go parabolic when there is this event that occurs, but I think until then, there is a lot of utility and a lot of things that can be unlocked by doing what we're doing.
That's a great optimism, Michael Wharton. Where do you see this platform, this real world asset, precious metals as a category, growing in 3 to 5 years term?
I think it's definitely the future. There's tremendous amount of opportunity that lies ahead for refiners, traders, vaults, exchanges, fintechs, investors. There are a lot of very unique use cases. Just to give one without sort of dropping names, there's a large football franchise that's planning to, tokenize gold so that they can reward their fans in gold tokens. Similarly, there's this talk about gold tokens being used as the winning points in video games. You compete and you win against each other. What do you redeem that has good tangible value, but at the same time is something that can easily be transferred. So there are a good number of utility use cases. I think it's not just the purchase, buy, sell, and the yield. There's so much more that this will eventually lead to, and I'm quite enthusiastic that the opportunity is immense. From my perspective in compliance and governance, I think tokenization will eventually succeed where governance succeeds. Compliance is not a barrier to innovation, though in the beginning it can be a little difficult. But for this specific amalgamation of two areas, one being gold trade and the other being crypto, which are both considered traditionally high risk, compliance is actually the mechanism that should allow innovation to scale safely. And that's just a basic message I want to drive home at the end of all this.
Right, that's excellent. With that, we conclude. Let me summarize what my little understanding is. Precious metal tokenization is here to stay. It may take pace in certain geographies, but larger adoption is going to happen when there is a real need for such instruments. One such need, as pointed out by Greg, could be a change in the world order. Having said that one, UAE and Singapore are at the leading edge when it comes to regulatory framework. They are evolving, but still there is a strong foundation in place. Fintech and technology platforms have matured and they can take real world assets. There are challenges, a number of them have been outlined, and along with the mitigation steps by our expert speakers. So the future for this class of assets is there, and it is for us to adopt, embrace, and grow with that. With that, I take this opportunity once again to thank profoundly, from the bottom of our heart, to all the 5 speakers, starting with Gregor Gergersen, founder Silver Bullion and the Reserve, Robert Farquhar, Chief Commercial Officer, Control All, Usman Saleem, co-founder and CEO, Oro Labs, Micheal So, co-founder and CEO, Tokenyze, and Michael Wharton, Director, AKW Consultants, for their time, for their perspective, and for clearly articulating on most of the questions that the audience have thrown. We had 208 registered participants. Almost about 125 made it. Most of them stayed till the end. I thank each one of you. Hope you found this series useful. If you have any suggestions, if you want more in-depth webinar masterclass formats, because this is a new area, we are here to help you out. Please put your requirements in the chat box. We will keep the chat box open for the next 10 minutes. You can continue to network with the fellow participants. Thank you once again, and I thank once again all the speakers for your time and presence. Thank you very much.
Okay. Have a good night. Bye-bye.
Bye. Thank you very much. Thank you.